Howdy, Team 42. It's your skipper here, Darius Dale, to present another episode of Macro Bundle Live for the month of July 2023. I'm joined with a special guest today, Jason Shapiro of the Crowded Market Report. How you doing today, Jason?
I'm good, thank you.
Hey, it's good to see you, man. So, where you dialing in from?
I'm in Rhode Island.
Rhode Island, a beautiful part of the country, man. So, what we like to do in this program is give the listeners and viewers a little bit of an opportunity to get to know you as an investor, as a trader. Give us a little bit of your background and kind of how you got to be where you are today.
Yeah, so I don't know. I'm 55 now. I started trading when I was about 21 or 22, and got into it kind of like how everybody gets into it. I was living in Hong Kong at the time, working a lame job, and it was a bull market, and seemed very exciting and a lot of noise out there about the stock market going up and all that stuff. And so I dove in, and I kind of got involved with that, and like a lot of young new traders, convinced myself I was a genius because there was a bull market going on. Made more money in the bull market than I was making at my job, type of thing.
Wow.
And well, that sounds like a great thing, but it's actually a horrible thing because it means I was way too leveraged, right? But as a young new person in a bull market, that tends to be what you do. And of course, that ends and you don't know when it's going to end, and you give all that money back, which is exactly what I did. And but I liked it, and I thought that it offered me something that fit my personality. I thought that it offered the possibility of a lifestyle that I wanted to eventually be able to live. I was not a very good employee, quite frankly.
Mhm.
So I knew that my future as a employee was not going to be great. I was obnoxious and I didn't listen to people, and bosses didn't like me. So I needed to find something in my life where that wasn't gonna that was gonna kind of be okay.
Yeah.
And trading seemed like it could do that. If you can make money trading, well, then the theory I've learned since that this is not totally the case, but the theory was, oh, then you don't have to listen to anybody because you just make money trading, right? So I stuck with it, and I did what a lot of people do. I read a lot of books, and I learned about fundamental analysis, and I learned about technical analysis, and actually went to school for a master's degree in finance, and kept learning and kept going through the cycle that I think, again, most people do, which is the boom bust. You made a bunch of money, lost a bunch of money, made a bunch of money, lost a bunch of money. Um, but I was at least very good from reading these books about trading and all that, and taking the suggestions of keeping trading diaries and all that. So I was able to, at one point, come to the conclusion, I think it was like the third time that I went through my boom bust, where I said, I really have to get this together because it's been 10 years and I'm now net nowhere, right?
Yeah.
Had some fun along the way, but I'm net nowhere. So let's really make a decision to stop this and figure out what's actually working and what's actually not. So I, went through these diaries, and I had done a real good job of organizing my trading diary, and really tried to eliminate the trades that weren't working over time. It's hard to do that when you're trading live because you have a trade that works, you think it's great, but do these trades actually work over time, not just one time or two times, right?
Mhm.
So I was able to go through the ones and like, okay, these type of trades don't work at a time. I'm done with them, right? And really focus on the stuff that was working over time. And that slowly became my trading process that I still use to this day.
That's a beautiful story, man. It sounds like, you and I are very much in agreement that all roads lead to systemization when it comes to investing. I mean,
I
there's a
think
lot.
the lesson I think I've learned is not just investing. I think it's important in life. It doesn't necessarily be systemization, but process. Things are
Yeah.
about process, no
Yeah.
matter what it is, whether you want to be a trader or whatever you want to do. You've got to have a process, and you've got to follow that process in a diligent manner, and not get off. And it's impossible to never get off track sometimes, but catch yourself when you're getting off track quickly and get back on track to process. And that I have found, my kids will tell you, I say this to them all the time, and they can't stand it, but that is what leads you to where you want to be is process.
Amen. Amen. Few people utter that word more often than I think the two of us, man. So I'm excited to really unpack this with you. So let's talk about your process. Sort of, you mentioned you went through a few boom bust cycles. to kind of iron out your process into what it is today. What are some of the core tenets of that process, and how do you implement it?
So the conclusion that I finally came to is that if you really break it down nice and simply, right, a very large percentage of people lose money doing this.
Totally.
You're talking over 95% of people lose money doing this, right? So to me, the lowest hanging fruit is to just find those 95% of the people and do the opposite, right? And if they're losing money doing it, then I can collect the money that they're losing. That's really, it's as simple as that. In theory, it's as simple, actually doing it is harder, but that's the basic theory of it all, right? Why not just be opposite of people that are losing money and make the money they're losing?
Yeah.
And it seems like a very easy place to find. If 95% of people are losing, well, then it's pretty easy to find them because it's 95% of the people out there, right?
Yeah.
To find the 5% of the people, okay, you just look on the billionaires list, but they're not talking to me, and they're not talking to anybody, about what their trades are. Some of them come on sometimes and we'll talk about the markets because the press wants them on there. But, like Druckenmiller gets in there sometimes and talks about things, but he's the first one to say, don't listen to me because I could be completely wrong. Right.
And or out of the trade.
Right. No, that's right. And he has said it many times where, and I have a current client who had money with Druckenmiller for a long time, who tells the story about how the guy would write these monthly reports and they were just beautifully written and so well thought out. And most of the time, completely wrong. And Druckenmiller says, I'm wrong far too often to count on being right to make money. I have to make money. So, and I kind of do the same thing. I write a weekly report now. And whereas I put in a bunch of things of what I think in there, it's really just a way to get it out of my system so that then I can get back to focusing on my process and not letting this stuff cloud my process judgment, right? I can sit here and make these macro arguments all day long, just like anybody else, right?
Yeah.
But at the end of the day, all I really want to do is be making markets to people that lose money over time.
Yeah, that makes a ton of sense, man. And so, in terms of like, you mentioned, I think, I was listening to your spot on forward guidance maybe a month ago or so, and you mentioned you sort of attack the CFTC data in a very different way than I think most of us are doing as investors. I think a lot of us kind of look at net length and all this other stuff and try to create some fancy math around that stuff. But it seems like, and not to, don't give us anything proprietary, but I think you just attack it from a different lens, and I think it's through the lens of who the small traders and what are they doing at the margins.
Well, I'm looking at what everybody's doing, but at the, being sort of this contrarian position, I'm trying to go opposite the masses. So
Yeah.
I'm looking for the commitments of traders to show a very one-sided bias, right? And at that point, that's when I'm looking to go. And the COT data is not perfect by any means, right? People say to me, well, where do you find where people are positioned? Because my whole theory is, if you're going to try and be contrarian, you can't be contrarian price. That'll get you run over. You want to be contrarian positioning, right?
Mm-hmm.
So where do you get your positioning data? Well, the COT data is positioning data. Not perfect, but it doesn't have to be perfect, right? Because I'm looking for it to be super crowded on one side, and then I'm looking to go the other way. I don't just go the other way. I wait for some market confirmation first, but once everyone's super crowded and I get market confirmation, then I go the other way. Does it work all the time? No. But what it puts in my favor is a huge amount of risk reward. If everybody's super crowded and this trade works for me, well, then, I'll make, $20. Whereas if it's super crowded and it doesn't work, I'll lose two. So if I can make 20, lose two, make 20, lose two, I always say my as I go through my history, my profitable trades are only about 38%,
Wow.
but it's 4-1. So if I could make 38% of the time and lose one, the other, whatever that is, 62% of the time, then I just need time to pass. I just need to do that and let time pass, make lose one, make four, lose one. And over time that adds up to profits.
Yeah, absolutely. And in terms of, you mentioned something like CFTC data is not perfect, which I agree with. I think anyone who's spent any time analyzing those time series realizes it's not perfect. But the beauty of financial markets and this business in general is that you don't need perfect information, right? We never have perfect information as investors. And so the
Never.
reality is, the same non-stationary time series, or sorry, the same stationary time series is the same stationary time series, even if it's not perfect. We know what the bounds are, we know what the extremes are, and we know where to, get the signal to take the other side of these some of these trades. In terms of some of these trades, like sort of, can you walk us through some like obvious things that are jumping off the page to you right now based on your process?
Yeah, it's been super slow for the last month or so, but where everything is showing up right now is currencies. Short British pound is the most crowded. Well, long British pound is the most crowded trade there is. So I'm shorting British pound, short yen. So I'm essentially going to be long yen, short British pound type of thing. Dollar in general, you know what I mean? And it not only shows up on the COT data, but it has a tendency to also show up in the mass press and all that, right? Nobody was talking dollar, and all of a sudden in the last week, everybody's talking dollar, right?
Totally.
All of a sudden the dollar's going back down to zero, right? So the contrarian trade here is to be looking to get long dollar. I am doing it in terms of short British pound.
Yeah, that makes sense. That makes sense. Anything on equities? I know you've done a great job of riding this bull run that we've seen in recent months. Anything on equities that might be kind of a big warning flag yet to take the other side of the trade?
No,
Small.
I tell you, I wish there were, dude, but there just isn't. They were massively short earlier in the year.
Yep.
It took them a long time to get out of those shorts. They're still a little bit short. They're not massively short anymore, but that's because clearly trend followers can't be short here, right?
Of course.
CTAs and the trend following community has had to, at the very least, get out of the shorts and probably are getting long, right?
Totally.
So that part of these shorts are out. Whereas the fundamental people and the macro people, I think, are still short, which is why we're still showing people net short stocks, but not to the massive extremes that they were. It took a long time to do that. And this has been a pretty amazing thing this year. Because usually by now the fundamental people will chase, but they're digging in, man. It's amazing how dug in they are to this. And it's not, I watched 37 different markets that I trade. So I see these behavioral patterns across all of them all the time. None of them are any different to me. It's very rare that you see people dig in like they're digging into here. And it really only happens with equities because that's what people get so emotional about,
Totally.
So yeah, they're pretty dug in, man. And so I have no interest in getting short anytime soon. Now, again, as we say, the COT data is not perfect. I never got short based off of COT in 2008.
Mm-hmm.
I never got, well, I wasn't trading back then, but my data will show that you wouldn't have gotten short in 87, so it doesn't catch everything like that. What it did catch, like in 2008, for example, was it caught other things short. It just didn't catch stocks short, right?
Yeah.
So you can make the argument the fact that I'm getting long yen here based on COT might be a bearish thing. You can make the argument if I'm getting long yen versus pound, which is very similar to euro, I'm essentially getting short euro yen, which is traditionally a risk off thing. So maybe that is a sign. But from what I'm hearing from the people that I listen to, from what I'm watching on TV and listening to these people, they're still dug in bearish, and I just can't see the market having a big drop anytime soon. This could go on for like a couple of years, man. You know what I mean?
You mean a couple of years? I've been thinking like 3-4 months. This thing is going to keep running. Like you're saying,
I've been thinking 3-4 months, except that was 3-4 months ago, and they're still not giving up. So now I got to go out another 3-4 months. It's just like the people that are talking recession, they just keep moving the goalpost out another 3-4 months, right?
They should subscribe to our research. We've been in the Q4 Q1 camp of next year since last November.
They should subscribe to you.
They should,
but they don't, because if it doesn't match what they say, then they don't want to hear it.
100%, man. And you hit something that's kind of you said something earlier that I want to unpack, which is how dug in this consensus is. We have a bunch of charts in our monthly deck. Colin, if you can throw the deck on the screen here, and it speaks volumes to what you just said. So what we're tracking here in this chart here, this is one of the 20 features in what we call our macro weather model, is we aggregate non-commercial net length across all the different equity futures and options contracts that they have that the CFTC reports data for. And I have been just shocked at the persistency of the net short signal. Like it's been like you would think that after a month like June, which we're obviously having another month like June here in July, you think after a month like June, okay, that's it. Shorts are covered. We saw dispersion get in terms of sector and stuff, active leadership broaden out. It looked like investors covered their shorts. But then when you go back and you check the data, it's like, nah, no, still very net short. And so, one of the things we try to look at in addition to the CFTC data are things like the AAI bull bear spread. We show everything on a percentile basis relative to its historical time series in this chart here, and we're still in the 18th percentile of U.S. equities. And when you go back and you look at all the equity peaks of bull market peaks since August of 1987, the equity bull market peaks somewhere in the 56th percentile on a median basis. Now, obviously, we've had numbers that are lower than that, numbers that are much higher than that in terms of equity market peaks. And then you typically see, AAI, bulls, bears somewhere in the 60th percentile. So it seems to me, if I can kind of reconcile the move in sentiment and the move in positioning relative to the move in price, it seems like sentiment has gone up from the lows of last October. We're now 64th percentile in terms of bulls, 68th percentile in terms of the bulls spread, but the actual positioning has not gone up. So what it sounds like
positioning is so much
telling
more
each other that
powerful.
they're bullish, but they're still positioned bearish.
It's so much more powerful than sentiment. I knew a person who used to fill out that AAI bull bear thing every month, and every week. All they really do is they look at the chart, and if it's going up, they say bullish, and if it's going down, they say bearish. Sentiment's one thing. Positioning is a whole nother thing.
Okay.
And I beg people, or I suggest to people, as someone who's considers himself contrarian, right? And somebody who has been on the bad side of being contrarian, right? You have to be contrarian positioning, not price. Everyone's going, oh, look at the market. It's a bubble. It's a bubble. Because it's gone up, it's a bubble. That's the biggest mistake there is, right? To me, that's the single biggest mistake there is, being contrarian, is trying to be contrarian price.
Yeah.
You have to be contrarian positioning, because positioning is what discounts in the market, not price, in my view. So, and not enough people pay attention to that. You know what I mean? Oh, everybody's bullish. Everyone's bullish. Everybody is not bullish. I can guarantee, look, the market can crash tomorrow for all I care. I'm telling you right now, everybody is not bullish. I watch what I like to refer to as Fade Money, which is the CNBC show every day at
Fade Money.
And you can watch last night's episode. You can go right online and listen to last night's episode, and then tell me that everybody is bullish. The woman, the opening question was, she's got all bears sitting there, and they've been bearish all year. She says, what is it going to take for you guys to throw in the towel and not be bearish? Which is a fair question, right?
Yeah.
And they wouldn't even answer the question. They just went right into the bearish narrative of why it's bearish and why it's more bear, and nothing's changed. The only thing, I love it, nothing's changed. The only thing that's changed is price. Okay, so the only thing that matters is all that's changed, right?
I know, right?
So not one of them answered the question. They just went right back into their bearish narrative. So you're telling me that sentiment is super bullish when you have these people, they don't even want to answer the question of where they would get bullish?
Yeah.
We're not even, and that's what makes me think it could be a year away, because I don't know what's going to change their mind. I just don't know what's going to do it.
Yeah, you're spot on. Look, we've seen sentiment be significantly more bullish. Like if you look at where sentiment was at the head of the October 2007, or at the October 2007 high, or at the March 2000 high, sentiment was much higher, or sorry, much more bullish than it is today. So there's definitely room to run from a sentiment perspective, but there's obviously, more importantly, to your point, there's a lot more room to run from a positioning standpoint. Is there a market? Like, obviously all market cycles are different. All business cycles are different. I think we do enough research to know that. But is there a time period in your experience trading markets that this kind of setup reminds you of?
No.
Dang. I was hoping you're going to give us some clues.
I really don't think that I have ever seen people so dug into the bearish story. I've seen people dug into the bullish story, and then watch the market go down, but I've never seen people so dug into the bearish story. After the 2008 crash and we had a rebound, people were sort of bearish into that rebound, right? But eventually they gave it up. I think after the COVID crash, people were bearish into the first part of the rebound.
Yeah.
but then they gave it up.
Vaccine news, yeah.
So I'm waiting for these people to give this up. It's just it's strange. It's amazing, really, what's going on this year. You can break out the rule book for trading, right? Go and look up top 20 trading rules or whatever that came from the Market Wizards books or something like that.
Yeah.
And you can this year was the perfect year to understand why those rules are in place, right? Don't fight the tape. Okay. Well, that's what everybody's been doing, and it has cost you, right? Don't let this, macro narrative, influence you so much that you're going to fight the tape. That's what everybody is doing here, right? And it's been amazing to watch, quite frankly. This was the one of the easiest and one of the most profitable contrarian trades I've ever seen.
Yeah, I
And
don't.
this is all I do. So,
No, I don't disagree with you, man. And I had to reteach myself a lot of lessons. Going back to Q4 of last year, had a horrible Q4. Pretty much everything I did was wrong, because it was all based upon what my central macro thesis was, particularly around liquidity. And then, so from basically October through mid-January, I was breaking every rule, fighting the tape. Here's my view: the market has to do this. This doesn't make sense. But then in mid-January, I just said, screw it. We got to pivot. The tape is telling me to pivot. Let's backfill the narrative, after the fact. And I think so much of what we do as investors is we try to make the market make sense. The market doesn't have to make sense according to your specific frameworks or according to your theses or what you were taught in business school or what you learned in the CFA program or what you've even learned throughout your career. The reality is the market's going to do what the market's going to do, and we need to adapt and create systems that allow us to take advantage of that, more frequently and more consistently. I think that's as simple as that. I mean, you talked about
amen to that, man.
100%,
I mean,
man.
that's just the fact. There's so many levels of where that goes wrong. You know what I mean? Eh, And there's so many. It's really all, at the end of the day, it's all psychological, right? People want to be right, you
Yeah.
know, um, and this is why they lose money over time. But not only does the market not have to make sense, the market almost by definition doesn't make sense, because if everybody can make sense of it, then everybody's positioned the same way, and therefore the odds are it's going to go the other way. Full stop.
Uh-huh.
This is all about, to me, it's all about positioning, right?
Yep.
And like these guys say, nothing has changed except the market's gone up. Okay, so then clearly it wasn't driven by fundamentals because nothing's changed.
Yep.
So why does it keep going up? It's because you keep shorting it. That's why it keeps going up. I hate to say it,
Yep.
right? But that's why it's going up, dude, because you keep shorting it. That's the only answer there is, right? And people don't want to hear that. Oh, are you saying I'm stupid? I'm not saying you're stupid. I'm saying you don't know how to freaking trade, which doesn't make you stupid. Okay. A lot of
Totally.
smart people that don't trade, right? But if what you're looking to be is smart, then be a physicist.
Yeah.
This is
Solve
not
it.
a game for the smart. This is a game that will destroy the smart.
Yeah. No, I
Except smart in another level. What you said 5 seconds ago is smart. I have to adapt. That's what a smart person does,
yeah.
right? I may be wrong. That the smartest thing that anyone ever says is I'm wrong.
Yeah.
Okay, that's what a smart person says. A smart person well realizes that they are wrong often. We are all wrong often, right?
Totally.
And you can either die by that or you can live by it. I'd rather live by it than die by it.
1,000%, man. Oh my God, it's so liberating hearing you say this, a veteran say this, because I try to I'm certainly no one in position to be teaching coaching, but I am good at macro risk management, and so from time to time I do try to impart these kind of wisdoms that I've learned throughout my career, to our subscriber base, and hopefully they appreciate that. Kind of one of the things I say all the time that you sort of echoed, just now, which is if a trade makes sense when you put it on, it's probably not going to make money. Like the trade kind of almost has to not make complete sense when you put it on, because if it does make complete sense, chances are that we are not the smartest people in the market, and the information's already out there. So
I always say you may be the single smartest person in the market,
I'm
but
not. But thank you.
no, but somebody may be. Okay, I doubt it, but somebody may be. But they're not smarter than everybody in the market combined. That's impossible.
Yeah,
So if that's the game you're playing a losing game.
yeah, 100%. Absolutely. And then this is so clearly there's just probably not in our client base, but certainly in other client bases and folks who may see this or may not see this. I think one of the hardest things to do, and certainly I've struggled with this, going back to mid Jan and really throughout this Q4 of last year. It's like I knew I was wrong from October to mid January, but I refused to change. I didn't refuse to change, but it was just very difficult intellectually to make that pivot, both professionally, because obviously I have clients and whatnot, but also personally, because it meant that I had to quit and give up on myself and give up on this thesis and this narrative that I spent so many hours developing and presenting and all this stuff. What's your best advice as someone who's done this for a long time to folks who have to capitulate and pivot and make that transition? How do they do it? What are the best practices that you've acquired over the course of your career?
So again, it all comes down to process, right? But it's harder from what you do, I think, because like you say, you have clients, right? You have a business, and your business is contingent upon your clients wanting to buy your service, right? So you're putting together this narrative of macro stuff and whatever, and they want to hear that because that's what they still believe is important. So, from your point of view, you kind of have to do that, right? Now, the balls, excuse my French,
No worries.
is what you did. Okay, this is what we're seeing, but you know what? It looks like it's wrong, so let's flip, right? That's the balls, and that's why that alone, right there, is why everybody should be buying your service. Personally, okay, you telling me that that's what you did? Nobody did that. None of the macro guys did that, right? All these people you still see, the guy from Morgan Stanley that's getting famous for his bearishness now, and all these people, they still haven't flipped, right? Yeah. But how do you do it? For me, it's easy because I'm only trading against consensus. So the question would have to be, if consensus is right, how do I flip my narrative, right? I don't flip my narrative. I just get stopped out, like I'm short British pound. Let's say if the British pound makes a new high, well, then I get stopped out. So I'm not going to get long, but I'll get stopped out of my short, so that's all part of my process, right? So it's easier for me because I can just put a stop in, whereas you have to now rebuild a whole narrative that's going to make sense to your clients and all that. So it's a lot harder for you, I think, than it is for as a trader. I just get stopped out. Okay, next question, next trade. I lose trades, like I say, over 60% of the time I'm losing trades. I don't want to say I love taking a loss, but truthfully, it's liberating. Here, I was wrong. I'm out. I'm done.
I was going to say I actually do, because most of the time, well, we're not in the business of taking big losses. We have risk management systems as well. And so when I do take a loss, it's usually like, man, thank God that's off my screen. I can get that brain space back. I was spending 15% of my thoughts on that. Now I get that 15% back to go do something else.
I don't like to be in the business of giving people trade ideas, right? We have this web page and all that. And really while I do my trades on there for people to see, what I'm really trying to get people to do is get their psychology right, understand risk management, and understand all this stuff. And I make videos that I put on YouTube, but and again, I'm not really trying to give trade ideas, but at some point this year, I got on there and made a video on YouTube where I was like, listen, stop it. Stop shorting. You have to stop shorting. Okay. If you want to be short, that's fine, but wait for some kind of market confirmation. I don't even care what it is. Let it go through the X-day moving average, whatever you believe works, right?
Yeah.
Wait for that before you short. You got to just stop shorting every day just because the market's going up and you think it's ridiculous, right?
Yeah.
So I forget what my point was, but it was supposed to be something to do with your point. But
it's on risk management and trading and sort of helping coach investors through some of these intellectual pivots, having a
right. So the point was, so I made that video, and then a whole bunch of people joined our Discord page after watching that video, and they're like, "Oh my God, thank you. I joined this because I want to say thank you because you made me stop shorting."
Yeah.
I was shorting all year, and you opened my eyes to why I need to stop shorting, at least for now, right? So that's what it is. It's liberating. Get out of your losing positions, man, and your mind clears right up. Now let's think about it. Now let's wait. Let's be patient. Patience is the name of the game here, right?
Totally.
shorting stocks anyway, we all know, is the single worst trade over time that exists in the world.
Jason, in mid-January, we stopped shorting forever and implemented a systematic long-only portfolio construction approach with all the risk management that we think investors need. I think shorting is, unless you're a top median, above median buy sider, you should not be shorting. Half of the buy side should not be shorting. Definitely, if you're a retail investor, you should not be shorting, because it's obviously the more asymmetric risk profile in terms of risk management. But secondarily, markets go up over time, and when they go up and everyone's short, they go up really fast and they don't let you in. You don't get to capitulate and buy a nice healthy dip. Oh, market's down 8 to 10, 12%, so I can cover all my shorts and get long. Nuh-uh. The market's not going to let you do that because everyone's still short. And this is why I say shorting, it causes so much heartache and headache. And I've learned this from experience. I realized after 18 months of running our business that I was not good at shorting. And so I said, hey, I just can't do this anymore. let me do what I do best, which is risk management, understanding the macro cycle, and just taken advantage of the beta that the market gods give us. So let me do that.
Good for you, man. I mean, I always say shorting the stock market, and I've done it a lot. Okay. And I've made some money shorting the stock market in my life, but I would bet over time, that's probably where I've lost the most money.
Yep. Same
in my life is shorting the stock market. Right. But I always say, it's like, I believe what must go on in your brain physiologically when you make money shorting the stock market has got to be very similar to what goes on in your brain when you shoot heroin. Right. I really believe that, because it's just that addicting. You short I've been there. You short the stock market. The market goes down. Everybody's losing money and you're making money. You're a hero, right? You're a genius. You're a hero. I don't know what the drug is that goes on in your brains. I'm not a doctor, but dopamine or whatever, right? I have no doubt that it's got to be a very similar chemical reaction. And so which means that it's super addicting, right? I tell people, like you say, don't ever short, because even if you make money, it's going to set you down a path that's going to lose you money over your lifetime, right? Because you're going to get addicted to it. So it's just like, hey, don't ever shoot heroin, right? I'm sure that if you shoot it, it feels great. I have no doubt about it, right? But where does that lead you? It leads you to be addicting to heroin, and that is not going to end well, okay? That has never ended well for anybody, right?
100%.
Maybe
Colin.
Keith Richards, I don't know, but
maybe Keith Richards. Yeah, I'm sure there's a lot of folks that would disagree in Keith Richards' family, but
so I really feel that way. And what you say is a retail investor should never short the stock market. Yeah. If you want to be bearish, fine, get out, put your money in bonds, right?
Yeah.
A retail investor should never short the stock market. I agree with that 100%.
I appreciate you agreeing with that. Colin, if you throw a slide up real quick. I just drew this, Jason, you probably see it. I just drew this diagram of prospect theory. So from Danny Kahneman and Emil Tversky, this is the chart of prospect theory, so like gains feel like half as good as losses feel bad. Basically, is the general take of that. When you short, you basically flip that on its head. So you're feeling the gain twice as much as everyone else's losses are. You know what I mean? I don't know if I'm explaining that well, but
I understand what you're saying. I like it. I think that's right. That's right. It goes right back to my heroin theory.
Exactly. And that's why people
feel too good, and you want to keep getting that feeling.
Yeah.
And meanwhile, you want to short something, short freaking wheat, short something that doesn't go up over time. The truth is, the stock market is the only market that has upward drift over time. So why is that the market that you are choosing to short? These other markets, don't have drift like that. Don't short. Wheat is arguably the same price that it was 500 years ago, inflation adjusted, right?
Yeah.
So short those markets, short a currency. The currencies go up and down, and they get that nowhere, right? You can make money shorting those. Why short the stock market? It's just, and look, I short the stock market. I was short for the first half of last year, but then that's wonderful, but that's because I have a process, and it told me that people were way too long and whatever. So I got short. But, Vic Niederhofer, who knows a thing or two about blowing out, always says that when he shorts the stock market, his position size is 25% of when he longs it.
Yeah.
Because you're dealing with drift. So
100%. And you're spot on. Like, I know we have different processes in terms of analyzing the CFTC data, but we observed something very similar at the beginning of last year. This chart on the left shows where, similar to the first chart we show, where we show aggregated non-commercial net length on a percentile basis and compare that relative to the AEI stuff. And we were in the 80th percentile at the highs of January 2022. So well north of where the market tends to peak in positioning terms, in January 22. It was a pretty clear signal that this is a good opportunity to be short. But then you get to like the lows of October 2022, we're somewhere in like the 18th or the 21st percentile, and that we're actually lower now. Folks have been incrementally getting more net short since the lows of last year. So that's a pretty interesting tale, man. And I'm really glad you said years earlier, because I've been of this view. So we have this fundamental view, right? That we've had this view since November, where we did a bunch of work on the yield curve and kind of relating it to the business cycle. And the conclusion of that work was the highest probability interval with which we should see a recession start is Q4 of 2024 to Q1 of 2020. Q4 of 2023 to Q1 of 2024. So obviously that's 4, 5, 6 months away, 7 months away. When we get there, and the market could potentially still be in a raging bull market, the fundamentalist in me is going to want to feel like, hey, I need to get short, or I need to tell people to sell and book gains and get short. But the reality is, what I'm relearning from this discussion that I'm having with you is that the positioning cycle and, layer that on with things like sentiment and momentum and things of that nature are going to be far more instructive in determining whether or not that's an appropriate time to change your positioning than just my fundamental view.
Damn straight. I mean, I always tell people when they have some view, what is your view? How is it different than everybody else's view, right? And if it's not different than anybody else's view, then how is it adding value, right? It's very, and not to disparage what you do, because clearly what you do adds a lot more to it than that.
Thank you.
But to look at something and say, the yield curve is inverted, therefore there's going to be a recession, therefore the stock market's going to go down. Okay. Who didn't know that at the end of last year? And this has become even more and more and more relevant as everybody can get data at their fingertips in 1 second, right? So who didn't know that is my point, right? So that doesn't mean it can't happen, but it means the risk reward is to bet against it, right?
Yep.
If you came to me at the beginning of this year and said, oh, you're bullish, is the NASDAQ going to go up 40% by June? I wouldn't have said yes.
No.
I don't know what it's going to do. All I know is I'm long, and hopefully it goes up that much, but
it goes up another 40.
Exactly. Yeah. So, and I also say to people that if I had given you on December 31st, every single piece of news that's come out between December 31st and now, where would you have told me the S&P would be? And my argument is you would have told me that the S&P would be somewhere around 3,000, right? If I told you all the data that came out, and I told you there was going to be this little banking crisis, and I told you that China was not going to come out of recession, and I told you that the Ukraine war was not going to get any better, and I told you all this stuff, can you honestly tell me that you would have said that the NASDAQ was up 40%? Now, maybe if I told you the AI stuff, maybe you would have said something like that, but I just don't believe that if I had given anybody all the data on December 31st, they would have told me that the S&P was up whatever it's up this year, 15, 16%. I can't see it.
No, when we pivoted in January, we put out a 4,200 price target. I learned this year never to put out a price target again.
Yeah.
What was the point of that? Who am I to tell the damn stock market, this $45 trillion beast, that it needs to stop at 4,200 because Darius Dell said so? That's a ridiculous concept, and I'm ashamed that I even did that. Right?
It's true, but you have to come up with something for your client. I mean, you have to do something for your client.
They're going to be disappointed going forward because I'm out of the business of giving price targets. So a few things that I've got out of this. I think we've gotten out of the business of shorting. We've gotten out of the business of providing price targets. I think we've tried to get into the business of helping investors understand that, look, the market cycle is different than what you think the business cycle are. And by the way, most people were wrong in the business cycle. I think, we all take a victory lap because I think I was one very lonely voice in all of global macro for the last 9 months saying, look, you guys are wrong on the timing of recession. We have a bunch of sophisticated models that track and measure economic momentum in the economy. And none of those models are even close to signaling anything like recession, at any point in time in the last 9 months. we'll see what happens 7 months from now. But we will take some credit for that, and that was part of the reason we made the pivot, because we understood that consensus was offsides on this recession view, in so much that inflation was actually coming down much faster than even we thought it would. But going back to this concept of like, you got to change, you got to evolve what you do, and it's not just to evolve what you do because it's currently evolving to what's currently working in this market cycle. I think when I say evolve what you do is to build systems and build processes and take the best of from each market cycle that you're learning with to the next market cycle, right? Like, you're going to build tools that fail and break. All models break. But what doesn't break is your willpower and your ability to constantly, reinvent yourself and tinker with your process and continue to grow.
Learn.
Yeah. Amen, brother. I got one question for you, so I don't want to take up too much more of your time, man. You've been fantastic and awesome. Just one question, and then we'll give you opportunity to sort of, help investors come find you on socials and all that stuff. So, Tom was asking a question earlier about your yen position, specifically, like, being long the yen versus the British pound as a potential risk off trade. And that's what your process is signaling. Do you sort of like beta adjust or vol target your position sizing such that, like, shorting the equity market is very similar to being long the yen versus the British pound in your portfolio? Or are you not doing something like that?
I do it in my brain.
Yeah.
But I don't do it in reality. In reality, I follow my process. Like, look, I don't want to be long yen here, man, because I still think that long yen is a bearish trade, and I'm not bearish in the least. So I don't want to be long yen.
Oh, sorry. Let's say long yen. I meant short the British pound. Yeah.
But even long yen short pound is arguably a bearish trade, and I don't want to have that on because I don't want to be bearish. But that's what my process does. So will I occasionally then hedge that by being long stocks? I'd like to say no, but the truth is yes, I will occasionally do that. I try to stick to my process 100%. It probably ends up being more like 98%. And CPI came out the other day or last week or whatever. I did get long stocks heading into CPI because I had this sort of, short, what I thought was a short risk trade on. So I did get long stocks into that just in case CPI came out weaker. CPI did come out weaker. It turned out the yen went up anyway, so I didn't even need to have that hedge on. But I 2 minutes after CPI came out, I was out of that stock trade because it was a hedge, and therefore I was out. So occasionally I do that, but I try very hard not to, because my process, at least to this point, and I've been doing it now over 20 years, it does what it needs to do. It does what it's supposed to do. It provides the returns, and it provides the Sharpe, and it provides the risk reward, and it provides the correlation to other things that I needed to do to run my business correctly. So I really don't want to do anything else. But even within that, even within me sitting here every day saying it's all about process, it's all about discipline, about 2% of the time, I still do it. Totally. And I'm talking about one that happened to work. Sometimes it doesn't work, clearly, right? So,
I'd say that's a pretty damn good ratio as a professional investor myself. Like 98.2% is a pretty good ratio. Most folks are probably closer to 50-50. So it's pretty good.
It should be zero. If I was,
it should be zero.
If I was true to my process, it should be zero. But sometimes we get off. We get off a little bit. We overthink it, and there it is.
There's always the shiny bouncing object that just is what it is in financial markets. So where can we send people to find you, man? This was fantastic. I'm going to put you in the category of unknown market wizards, but obviously you're now being known, and so we appreciate you sharing your wisdom and your experience with us, man.
Yeah, I mean, I have this webpage that we started after I was in that Unknown Market Wizards book.
Oh, you actually are?
Yeah.
Oh, shit. Oh, pardon me.
Yeah. So I was in that book. It came out a couple of years ago. Jack Schwiger book. And after that, a lot of people were hitting me up, can you teach me? Can you mentor me? This and that. And I do like to do that. I had that offered to me when I was younger. And I feel like that's part of life in general. You want to sort of pay it forward type of thing. But I couldn't do it with 200 people. I have a family, I have a business, and one of the people that I said that to, I said, look, I'd love to help you, but I can't do it. He said, well, why don't I start a web page, and then you could centralize it and all that. And me being 55, I didn't even know what Discord I didn't even know what that meant. Okay. I literally did not know what Discord meant. But he started this web page, and we have a Discord page that we talk on all day about this stuff. And I put out a newsletter on the weekends, which really is just what I used to do for myself every weekend, putting my thoughts on paper, right? Here's the trades I'm looking at. Here's why. Here's what needs to happen for me to put them on, right? And here's a bunch of macro bullcrap that I want to get out of my system so that I can write it down and not actually have to act on. So I used to do that. I've done it for years, every weekend. So we turned that into this newsletter that we send out on our webpage every weekend, every Sunday it comes out. And then it flows into the Discord where we then talk about it and we talk about other stuff. And we also provide charts for the Commitments to Trader, which you can get for free on the internet, quite frankly. But I think that the charts, obviously I'm biased, but the charts that we provide are much more interactive and cover every single market. And you can also change the date periods. You should also go combine them. Like, okay, here's the S&P, but what about if I want to look at the entire, stock market? Okay, well, you can get on there and make it S&P, NASDAQ, Russell, Dow, and you can chart that on a Commitment to Traders basis. So that's kind of what we offer on there. And I will say, what I try very hard not to be is a tip sheet. I'm not looking to be a tip sheet. I beg people, don't come on here and be like, oh, Jason's a market wizard. Jason has, really good returns. I'm just going to take all of his trades. You can do that because I do put my trades on there and I do show them live on the Discord, but I recommend not doing that to people very much because you're not me and I'm not you. I can't trade your process, and you trading my process is not going to work over time. I know this, right? You probably aren't going to believe me, but I know this because I'm going to have 3 losing trades in a row. You're going to think that I'm a moron. You're not going to take the 4th trade. The 4th trade is going to be a home run. So for the net of the 4 trades is you're going to be down money and I'm going to be up money, right? Yeah. That's just how it is, or it's just human nature. And so that's really not what we're pushing in this whole thing. What we're pushing is the idea of how to be contrarian, how to think about the markets, how the markets are not what are being presented to you on financial press, right? So therefore, what does matter? Positioning, sentiment, how to fade people, how to find fades, how to find good risk reward. It's not about being right. It's about getting into good risk reward situations, which sometimes you get the bad end of, but sometimes you get the good end of. And hopefully the good end is $10 and the bad end is $1. How to find those situations. That's really what we focus on that thing. So if people are interested in that, then they should join us, crowdedmarketreport.com. I'm also on Twitter. And I also do YouTube videos that are free every Saturday or Sunday. I think Sunday we put them on there. And I try to pick a topic, about risk. It's usually about risk management. Once in a while, I'll get into the current market. But I try not to because I really don't want this to be a tip sheet. I want it to be a learning experience, how you actually can develop something that will make money over time. Jason Shapiro. Jason Shapiro ain't going to be here every day. It isn't going to be here forever. So, we're trying to, the old saying, we're not trying to give people fish. We're trying to teach people how to fish.
Amen. Amen. You said a lot of things that we try to echo and teach our customers and clients. Obviously with a lot more, experience and success in this business. So I just want to say thank you for taking the time to do this with us. We're definitely going to have you back on the program at some point, man. This was fantastic. If I'd like to leave the audience with one final question, my favorite final question, which is, what's the number one risk management learning that you've learned thus far in your career that you wish you knew on day one?
Take your loss and take it quick.
Yep.
You know what I mean? Be wrong. It's fine. You know what I mean? Take your loss. Don't get married to it. The shorting of the stock market here is the perfect example. You may be 100% right. The market is about to crash. Okay. I promise you, you ain't going to cover today and wake up tomorrow and it's going to be down 30% on the open. It's not going to happen. Go back and look at what crashes look like. 87, the market topped in August. It crashed in October, right? 2008, the market topped in 2007 and it crashed in October of 2008.
Yeah.
You ain't going to miss it, man. You know what I mean? Like, just take your loss, move on. That's the number one risk management tool, I think.
I appreciate that, Jason. Well, we'll wrap it up there. Everyone, thanks for joining us. This phenomenal discussion. I will catch you back here next month with Chris Sidio from Amherst Group. Cheers.